Uh, Thanks, Mark, and standard disclosure page for compliance purposes. There will be forward-looking statements. Some of them will be accurate, most won't. I want to talk about two big things that happened last week, the BRIC Summit in South Africa and the Jackson Hole Symposium from the central bankers getting together. And I think it's really pretty timely given the all the stuff that's going on in the world the last couple of years, and it's really created a setup where you have inflation coming back to rear its ugly head. You have policymakers stating in Jackson Hole that the fight's not done on taming inflation, but you also have these BRIC nations looking to change the landscape and change the balance of power economically around. So these are big events that are not unrelated. And one of the themes that comes out of it is how do we get a more level playing field for all the countries, and how do we move away from a really West-dominated, G7-dominated global economy to one that's more balanced and reflective of not only the population shifts, but also some of the other changes that are going on. So what was the purpose of the summit? It's really about changing the global landscape away from a US-led dollar-denominated model to one that provides other nations a greater say in how the world operates. And one of the challenges with that for the BRIC nations is that a lot of the member nations all want something different. Their needs are very different. So they're trying to figure out how they all fit and how they play in this new global economy, and how do they play against it in this post-pandemic war in Europe, changing global terms of trade, and energy transitions that are going on. It's a very different world. So how do they think about that? So coming out of the meeting, you ended up with the BRICS expanded, adding 6 new nations in. This is what it looks like on a GDP basis. The blue is the G7, the red is the BRICS original 5 countries: Brazil, Russia, India, China, and South Africa. And then the pink is the expanded area. And you can see on the left, it's nominal GDP on a purchasing parity basis, and then what their populations would look like. And you can see the shift is really part of what they're demanding is a more level playing field between the G7 and the rest of the world, and how they are represented, mainly at multinational institutions like the World Trade Organization and other governing institutions that were set up after World War II. I think part of what you're seeing is a frustration that the governing institutions, while they might have been appropriate for the time, aren't reflective of the current environment or the changes that have occurred since then. So some of the key takeaways are they clearly want a greater role in the global decision-making, but more than that, this is about a realignment of the global economy and how it operates and how geopolitics work as well. So they added 6 new members, you can see from the list. But for several years now, President Xi has been really seeking to reform the international financial and monetary system away from the US led and give them more of an equal weighting. And actually, it's really about how China gets as much a part about how China gets their positioning and stage that they feel they deserve as a global leader. I think that's one of the big plays. But there has also been a lot of talk about a common currency for the BRICS to de-dollarize the world. And I think that's an interesting discussion, but one that is not very likely. Jim O'Neill, who created the term BRICS from Goldman Sachs, thinks it's an embarrassment that they're even having the discussion on it. And the reason for it is pretty simple. Picture the BRICS trying to pull together with leaders of Russia, China, India, and the like, adding into it leaders of Iran, Saudi Arabia, and the rest, and having them think about their needs of their national needs with how they fit as a global community, and picture the challenges that the European Union faces with a common currency and a single central bank that's not backed by a common fiscal regime, and you can see a real mess coming if they tried to move to a common currency. So I don't think the US dollar is at great risk in the near term or even in the intermediate term of being usurped, but it is a move to try and shift more of the trade away from the dollar and reduce the powers of the dollar. But I think the most important thing coming out of this is that it's ushering in a new era for middle powers, and it's not going to be the US or the West and the G7 against autocratic nations. It's really going to be a much more balanced global economy where these middle powers will play both sides against the middle in ways that I think are very helpful for them to raise their standard and get from the East and the West both what they need to raise their standard of living and continue to do better for their own populations. This change, this expansion of the group, this meeting matters most to China. And I would say it matters to the other countries, but China is really trying to take the lead to drive this change, to usurp the US, or at least become a level partner to the US in the global stage. But it is important economically too. As you can see here, this is the Belt and Road Initiative countries and the exports that China makes to them, which have passed now the exports to the US, EU, and Japan. And that actually has changed the dynamic for them. And when you think about the population in that market that I showed on this page, you can see they're going after really half the world's population in this expanded BRIC construct. So right off the bat, they're getting big representation and big market opportunities with some big challenges that go with it. But this is also important to China from a national security perspective. It's important from global positioning, but it's coming at a terrible time for China, where you don't want to be coming out as change to our model and move away from the US model when your economy is going through what looks like some serious multi-year challenges on the property side, on the debt side, on the financial institutions, and then they've come out of a period where their national corporate champions were under a lot of pressure. So this isn't an ideal time to be saying, look at the China model as the example of where you want to go. But at the same time, the US model hasn't worked for long enough for a lot of these countries that the China model might be a healthy alternative. So let's switch gears to Jackson Hole. And the theme at Jackson Hole is the structural shifts in the global economy, which what we just talked about is one of those major structural shifts where you're seeing a realignment of major economic activity along geopolitical lines. One of the big takeaways from that is, what do we think about how does the world change and what's the playbook like for central bankers? And I guess the couple takeaways from the meeting are at a very high level. The higher for longer is going to be for longer on interest rates. And the market has gotten this wrong for some time. We expect that short of a major financial crisis, the US will be holding rates up for longer than people would think, and may see another rate increase, as Powell had indicated in his speech in Jackson Hole on Friday. And while inflation has come down, both Powell and Lagarde were very clear on the fact that they are concerned that is at troubling levels, and there's a lot of reasons for them to be concerned about where inflation is that I'll touch on in a minute. But clearly they don't view that the job has been done. And in Lagarde's case, and I think in Powell's case as well, they're worried that if they don't arrest the growth of inflation right now and put it to bed once and for all in this period, that you'll see a creep into an inflation where you have wage price spirals that are going to have wages going up and have companies pushing their prices up to deal with the wages. So I think that's one of the big issues. I think two things came out of this that were pretty clear messages from both Powell and Lagarde. One is that they're not done the job on inflation, and they're going to keep at it for longer, which means rates are going to stay up. The other is they don't know, and this is probably the clearest they've been in a long time on what neutral rates should be. And in both cases and in both their speeches, both Powell and Lagarde said they have really no way of knowing where the neutral rate should be because of the tremendous economic distortions that have occurred over the last couple of years, whether it was the pandemic, the lockdown that we've seen from that, the supply chain disruptions and distortions that are coming from that, the reopening, the sanctions, the war, all those things have created a very unusual environment. So when they look at the old playbook, it creates a roadmap that's not the right one for the environment that we're in. The other element that you have to keep in mind is the amount of stimulus, both monetary and fiscal, that's gone into the system is unprecedented. And the lag effect, both on the way in of stimulating the economy and then the tightening that we've had over the last year, are creating distortions that make it very hard for people, for policymakers to really understand where we are at any point in time. And this was the clearest they've been on the fact that they really don't know. And I think that's important because it says to me they're going to err on the side of killing inflation rather than promoting growth. They're not going to. They can't have inflation run away from them right now. I think that's kind of the central message from both. And while inflation, as you can see, this is a slide from Powell's session. He's showing headline inflation here. Excuse me. And as you can see that it's come down a bit over the last 12 months, the fear right now is that you have two areas that could see a reversal, and that's food with the grain issues with Russia, and also with some export controls from other nations on grain prices, and then the weather issues you have. And then we got a break last year on energy prices coming down because the winter and the management of the energy squeeze that we had last winter was done well, but I don't think we can count on that same thing applying this year. But I think the bigger issue, and the one that's really troubling for central banks right now, and this is one for the Fed, but I think it's around the world, is you have central bank policy trying to be restrictive and to arrest inflation while you have 40% wage increases for unions and other employees popping up on a regular basis. And these are, in the US, unions represent about 11% of the labor force. So it's important and it's big, but it's not as big as it used to be. But still, you have to deal with those wage increases. And that creates a problem for the Fed, where they're trying to fight avoiding this wage price spiral at a time that you have big increases that are going to be embedded in the system for a while. Can we really get inflation down to the 2% level that the central banks have? Probably going to be very difficult for them, certainly in the intermediate term, without a big problem in the system. However, getting it closer to the 3% level, I think, will allow the economy to get to a spot where they can say maybe later on that they can move off the 2%, but they're not going to do it right now. And that message was reinforced in Jackson Hole. I think the other thing that Lagarde mentioned is when you have these problems with inflation and price moves and the uncertainty continues to increase, it does bleed into the real economy. As you can see, the European business activity is declining, as indicated by the Purchasing Manager Index. It's below 50 on all three levels: composite, services, and manufacturing, which is in a contractionary mode. You combine that with the fact that a lot of capital is leaving and coming back to the US and other areas, is creating some challenges for them. And then you have the confidence crisis that follows with that as we move into a more difficult time. I think this is a bit of a challenging period. The other challenge for the central bankers coming out of this, and it's really baffling them, is how we can continue to have such tight labor markets and the problems that that's creating for central bank policy as well, as it keeps pushing the wages up. So one of the key messages that they need a new playbook. You can't drive in the rearview mirror with the changes that are going on today, whether it's the global fragmentation we talked about, the distortions in the labor markets, the secular headwinds on demographics, where two of the leading nations, Japan and China, are turning into nursing homes. This energy transition, while it's ongoing and it's critical and important, is much more difficult and costly than we thought. And all this is happening when the central banks have expended a lot of their firepower. So there's much less support for the system, whether it's on the fiscal side or the monetary side, to continue on. So when we sit and look at the world today from a market perspective, we think that the pullback we're having this month is perfectly normal after such a strong market move that we've had already this year for the last 9 months, and that a pause that refreshes is absolutely required. We think that there's going to continue to be a battle between where interest rates are going and how does the 10-year resolve itself? Do short rates come down? Does the long end move up? Or do you see a meeting in the middle? And does that allow a soft landing or a hard landing? That's going to be one of the key issues that they have to focus on. But all this is happening when you have the advent of AI and other technologies that are coming in that are also changing the landscape. Are going to be very essential to deal with the labor market tightness and the secular demographic headwinds, as well as ensuring that the clean energy transition works effectively and efficiently. So what we would expect is that rates will be range bound for some time. The market's going to take a pause that will give it a chance to refresh. The market's now assessing the quarterly earnings and trying to determine those companies that are on the wrong end of the higher rate structure that will no longer be able to finance their growth effectively, or their debt is going to be too high for them to crowd out other spends. So we see this change going on that's going to be take some adjustment, and you can't discount what is trying to be done with the BRICS changing the landscape from a geopolitical and economic perspective, and what it means for the G7 economies and what it means for the global economy overall. And the more we have this fragmentation, the higher the costs in the system are. The higher the costs in the system are, the more inflation is bedded, the longer rates stay higher, the more difficult it is to get out of the challenge. So while we're not negative on the global system or positive on the global system, we're somewhat neutral, but we think there are pockets of opportunities, but there are things that have gotten ahead of themselves, like the AI area, that need to just have the consolidation period and refresh before they move forward. But we also think that AI will not be a leveling technology. We think it's going to make things more unequal for companies, and those that have the strong balance sheets and the ability to hire the right people and spend to hire and make the investments now will be the ones that will be benefiting, and those with highly indebted, weak balance sheets and slow growth are going to be left by the side of the road. So it's very much going to be about selection in the public and private markets, but you do have more choices with the higher interest rate levels, but it is a time for caution as we move into what's always sloppy times in the markets. So Mark, I'm going to stop there and we can open up for questions, contrary views, and discussion.
Adam Blanco, out of the pack.
Oh, morning, everyone. Thank you, Stephen. Great presentation. My question is about the BRICS, the expansion of the BRICS. Two questions about it. First, a common currency of the BRICS. Highly unlikely anytime soon. Exactly. But what would possible constructs of a common currency be, such as, for example, IMF SDRs? Would that be a possibility, the special drawing rights, or them collectively going to a gold standard? That's my first question. Second question is, your view of the BRICS, is that more of an economic alliance or a political alliance, or both? Those are my two questions.
Let me start with the second question first. The view of the BRICS depends on the nation. And each nation, it's one of the challenges with the construct of the BRICS is they all have different self-interests that they're trying to meet, which will make, it's the same problem with the European Union, right? It's what's the failure of the European Union? It's a monetary union with not a fiscal union, so they can't get the things done that they need to do. And I think that's going to continue to be an issue. I think what China wants out of it is different, very different than what South Africa wants out of it, which is different than what Russia wants out of it. So I think that's always going to be part of the problem that they have of getting together. And I would actually suggest that the nations that are moving away from the US should be careful what they wish for, because they may be moving into something that could even be worse than the dysfunction that the US provides on the global system. I think and that is part of the reason that a lot of that China's throwing out an alternative to the West that has failed a lot of these countries throughout, because of our inconsistency and our not being straightforward with them and all that. So there's a real reason why they're looking for an alternative. I think the common currency issue and the other issues get back to these guys want more balance to how the post World War II governing organizations treat them. In China's case, they want the best of both worlds. They want to be treated as a developing economy and be treated as a leading nation at the same time. So they want it politically for one and economically for the other. So it's that's part of the challenge. So I think it's going to be very difficult for them to get to a common currency. I think it'll be impossible to get to one that works. I think it will highlight the fragmentation that's always going to persist there, and it's going to actually show that that be careful what you wish for of who you're getting in bed with, because they could always be worse than the ones you were previously with. And I think that's what's going to be the worries. This could be one where they eat each other over time.
Thank you, Stephen.
Welcome.
Luke?
Hey everyone, I got two questions for you, Stephen. So with China and its current economic challenges, there's three main things that I've been hearing. Different rumors in the economy there, whether it's real estate or other areas, significant I guess offshoring or onshoring of different companies from the US, taking their products away from manufacturing in China, and a lot of shifts to other Asian countries to do other manufacturing, a significant shift in Apple to from China to India, et cetera. And also the government that stopped reporting on youth unemployment, which is a major problem there, supposedly. How does that affect BRICS? And then I have a second question on how does the resuming of the student loan, education loan payments that are going to come starting September, October timeframe, how's that going to have an effect on the economy? Because that's going to take a lot of discretionary spending off the table.
Yeah, I think the answer to the first question is I think China's economic woes couldn't come at a worse time for them with what they're trying to do. But at the same time, I think China can will work through over time their economic woes. It could be the question that's out there right now is, do they become like Japan or are they just going through a normal slowdown? I think it's too soon to know. I suspect that they can manage through their problems over time. They are doing what is an economic transition from a low-cost manufacturer up the value chain. So you do have these periods where you go through dislocations. I also think, though, that they were locked into a system for too long, that they needed to make the shift sooner. And I think the problems of the last 15 years in the global economy probably didn't allow them to move as quickly as they would have liked. But if I was an emerging economy thinking about joining the BRICS to benefit for myself, I'd have to think long and hard about how do my interests align in the areas that China's focused on versus what my areas of priority are, and are they complementary or not? And if they are, then I can work with China. If they're not, I'm going to find somebody that they're more complementary with. And I think this is going to be where the middle power starts to come in, where you'll see a lot more of these nations playing both sides against the middle, the US and China, and picking us off for the best they can do, which is the smart thing to do if you were them. I think I'm sorry, the second question that you had.
The resuming of the student
Right.
loan payments and what that effect is on the economy, taking discretionary spending away.
Yeah, I think it's I think it's just part of the process where the stimulus that's been in and the advantages that we've had for consumers will slowly start to fade. I think this is one that will be felt, but I think people are already starting to. They felt it was coming, so I think they were starting to plan for it. But I think I've been worried for some time, and I was convinced in Newport not to be worried about the consumer. I was thinking that they were going to run out of funds sooner. And at that Newport meeting, I heard some really good arguments for why that's not the case. But I think what's happening is we're looking at the numbers, and when you have a period of stimulus that happens, when you realize that you have a problem, you start slowing your spending down twice as fast as it takes twice as long to happen, and then it happens twice as fast. And I think that's what we're going to see all of a sudden on consumer spending for a lot of the people, then they're going to run out of funds pretty fast. And I think student loans is going to be one of the things that augments that. But I think it's just they're running out of money because wages have not always kept up with the inflation that we've had. And I think that's part of the problem. So I think it will slow down the economy and you'll see it start to hit the consumers. Sorry.
Other questions, comments?
for the long answer on that one.
Well, the other factor we talked about the last couple of weeks is the higher interest rates, higher strain on disposable income from that on from credit cards and on.
Yeah, it's real, and it's coming, and the costs. We are seeing, what looks like costs embedding more permanently in a lot of areas. So.
Yep.
I think the real challenge, Mark, is how do these 40% wage increases work through the system, and can companies manage their earnings and their margins through that without raising prices so much that they choke off consumption?
Mr. Daly.
I just wanted to say out loud, consistently Stephen Burke's message is well thought out, well researched, very articulate, and very reasonable. Your hair is never on fire. There's a reason you do this broadcast, not me, because I'd be hysterical half the time. So I do appreciate how reasonable, no matter what's going on Earth, you're like right down the middle. Long-term view for U.S. equities is good, carefully selected.
Yeah, well,
Okay.
I actually think one of the things that's come out of the last couple months, and even the BRIC meeting in South Africa, is with all the problems in the world, the U.S. is sucking capital out of the rest of the world. Why would that be? And it's because it's the place that people can invest with the highest degree of confidence in the capital market system, with the faith of the rule of law and the innovation and all the other things that are behind it. So I'm not negative on the rest of the world, but with all the problems that the U.S. has, which we talk about a lot, and just look at the election coming up for next year, if you want to have wonder how people could have confidence investing in the U.S. But it really speaks to the institutional system that's in place here, both from an economic, political, and social perspective, that I think is very fortunate for us, and we take it for granted way too much. But I think when you see us attracting capital the way we are, where our interest rates are staying relatively low with the financial backdrop, I think it's a really interesting setup and speaks to the strength of the U.S. economy.
Andrew
Thank
Voss.
you for the kind words, Michael.
Andrew Voss.
Thanks, guys. Hello, 361. Stephen, there's been chatter. I'm starting to see a lot of people wearing masks again. There's talk of new variants coming on the scene. Can the country take it again economically if we're going to get into any kind of a lockdown situation or anything resembling what we went through over the last few years?
I don't know the answer to the question, but I don't suspect we'll go into a lockdown like that again. Well, only because I think they're counting on the vaccines to help push through.
Yeah, if I could interject as well, it was interesting, kind of listening to national news a few days ago when they were reporting on it. It was sort of snuck in at the last second in the report that these latest variants are not any worse than any of the other ones that we've had. And so I think that it's unlikely that we'll have any kind of lockdown or requirements moving forward. I mean, people may choose on their own to mask up more, but I think that the governments have probably, as in like local governments, have probably seen how awful those decisions were at the end of the day. And it would have to be pretty darn serious for them to embark on that road again.
Yeah, I would also just add that the healthcare system is better structured for it, so there'd be less panic. We do have vaccines that people know have worked in the past and can be adapted for new. And I would just say the last thing is, I suspect that history books will not be kind to the China lockdown, extending as long as it did as a for the damage it's done economically and politically to them. I think in a geopolitically, I think they're going to find that that is not the route you'd go going forward.
I don't want to get in front of,
You know-
of my friend Rob there, but if I could just kind of comment question. See, this whole thing about the wage contracts is really quite interesting. And thinking back, I wasn't that old back in the early 70s into the 80s, but I do remember. And it seems as though that, as you point out, unions are a much smaller representation of workers now than they were back then. Also, I wonder about just the level of competition that has come into at least this economy, if not others, and how that might be a mitigating force as well, to keep prices in check. That's the question.
Well, I think it's a great question, Bill. I think I think part of the challenge is I think part of the challenge around that is really going to come down to the availability of labor, which is so tight right now that if we had some better policies, they'd have more competition. I think what's changed right now is the sanctions and the tariffs and all that have been, we've started to erect barriers to trade that we didn't have for a lot of that time. So I think there's some puts and takes here that are going to come down to how is the availability of labor in the areas that they're getting the wages pushed up right now, and what's the competition like, and it just so happens that it's a time for a lot of the unions that were bringing stuff back to the U.S., which gives them more strength. So I think there's a lot of factors at play. I don't think they'll ever get back to where they were, and I think after this run, I think they're going to be in a different spot where they won't have the same power going forward because of productivity improvements. So I think this is one of the potentially big last gasps for them to get good wages while you don't have that competition.
Yeah.
Labor tightness.
Just on the virus, I just looked up some stats. I'm not seeing any major difference, like a slight tick, but I am anecdotally hearing a lot of people with COVID. Rob?
Yeah, I had a question, but just a comment on that side. Recent the wildfire smoke was almost like reverse of that went to the Northeast and even down to the
Rob's going in and out.
where you actually go inside. Oh, you had to go inside.
I'll stop your video. Keep going.
Good idea. Okay. What I was just saying is that the recent Canadian wildfire smoke was a reverse psychology of going inside for ventilation and closing windows or what have you. So the good news is you found a way to hunker down and be reactive. But I guess the bad news was that you couldn't be outside, but you had to be inside. My quick question was on policy, and I think, Steve, you were commenting a little bit on the national side. Were there any tidbits you picked up on the recent Republican debate? It seemed like the biotech entrepreneur got a lot of heat, but he wanted it. Got invisibility. And there was this element of new guard versus old guard. I was just curious if you had any tidbits there.
I don't. I actually the early election stuff I don't really pay as much attention to because I think at this time I really don't focus on it until you get closer to who's actually running. So I don't really focus on the messaging other than for amusement. purposes, to be honest with you.
Okay. Fair enough. And noticeably that I guess the primary person who's probably going to take that, didn't show up. So fair enough. Let me defer to Walter here.
Mhm. Thanks, Rob. And Stephen, thanks again for the presentation. Always stellar. Two quick questions for you. One of them, and I'm going to take you back to BRICS a bit, if that's okay with you. When in your presentation, you showed a graphic and you showed the comparison between the West, GDP, population, et cetera. Is that the old BRICS or is that the new BRICS?
That was both. I'll pull it up here. Mark, can you let me take the screen?
Yep.
Missed that.
This is it. So it is. It was this slide, and that would be. There we go. Sorry. So what you can see on the right is GDP. In the blue is the G7. The red that you can see here is the original BRIC 5 nations, and then the pink is the additional nations coming in. So they're not making a big change in the economy, although when you add in the world's largest oil producer and one of the other largest oil producers and another one of the largest oil producers, it does start to change the dynamic a bit.
Mm-hmm. And then my other question was around exactly that, the selection of the countries that were allowed in and those that were actually excluded. I thought that was interesting. Would like your insights on that. I was surprised to see some countries like Egypt in and other countries like Indonesia, Nigeria out. So,
yeah, there was, I think, 40 countries that either threw their hat in to be considered or wanted to be considered for it. I don't know the process for it, and I don't know the selection criteria. But it's clearly from China's perspective and Russia's perspective, it's who can weaken the U.S. fastest. That's really it. It's pretty straightforward. What's being done here is how do you neutralize the West's power and raise our stature? And you'll go for the countries that can weaken us fastest. And when Gina Raimondo's over talking about, we can't negotiate on national security, you look at the nations and it's about energy and rare earths and other natural resources that are prevalent in a lot of the African nations that they're going after, and the future growth market for population. So it's pretty straightforward where they're going, why they're going, where they're going. And you can think of the nations that they really want to attract in going forward will be ones that have resources and good populations and kind of critical national security plays as well.
thank you.
You're welcome.
Any other questions, comments? And
Andrew?
If you've already commented on this, Stephen, I apologize, but where are we with the national debt and debt ceiling issues? That always seems to be a looming major issue contextually with everything that we speak about on these calls.
We talk about a debt ceiling and then we keep raising it. So is there really a ceiling or not is an interesting question. But we are, there's some more negotiations that have to happen in the fall or either October or December. But they'll kick the can down because nobody wants to, right before an election, be the one to get the black mark as you're screwing everyone right before an election, 12 months before an election. So I think the debt ceiling will resolve itself. The bigger issue is the deficits and when are we going to finally get serious about the financial position of the country, and how do we do that? I think that's got to come, not likely in this election, but maybe in 4 more years. They'll finally get serious about that, or maybe in the midterms between now and the next election. But I don't think it's going to be. We're not going to get financial discipline in the next 12 months.
And we're hovering at around 33 trillion.
Yeah, I think 32 trillion right now, of which 26 trillion is held by the public. The rest is pushed around inside the US government. About 7 of that is held by foreign entities, and 2 trillion of that is held by Japan and China, with the UK third at like $775 billion of treasuries that they hold. And it's interesting, in the last month, it looks like the Japan and China combined reduced their treasury holdings by 200 billion dollars out of 2 trillion, so 10%, and yet you wouldn't notice it in the markets. So I just think it's a lot of interesting dynamics there. But when you think about the debt held by Japan and China, I think in 05 or so, we probably had around 10 trillion of debt. Now we're at 30 trillion. So they were probably pushing around $1.5 trillion of debt then, but on a much lower basis. So they were a much bigger element of the ownership then than they are now. So I think that's something to keep in mind when you hear all the worries about what if China decides to sell all their treasuries. It's $900 billion. The Treasury and the Fed could absorb that if they so needed to. So that's not a worry, but the debt is a big worry, and it's a worry at higher interest rates. And I think we have to get used to higher interest rates and expect that they'll be crowding out of spending coming with that, and higher taxes coming as well.